From the University of Westminster, this is the Week Ahead with Dave Coker.
All right, guys, let's get started. It's Sunday, February 7th. My name is Dave Coker, and this is, of course, the Week Ahead. Let's get an idea about what's going to happen over the next 5 trading days. So, in terms of events, you can see I fixed my animation there. It's all coming out at once. We've got Q4 earnings coming in, and we've had better than expected results so far. That's why we're seeing shares tending to do pretty well. We do expect to see this week some big giants. We got Cisco, Twitter, Coca-Cola, AstraZeneca, Walt Disney, a bunch of companies reporting. So we'll have to see exactly what the overall effect is there. Stimulus talks ongoing. Of course, Mr. Biden wants $1.9 trillion in COVID relief. The Republicans are pushing back against this. They proposed a $600 billion aid package. Not totally sure how this is all going to shake out. They're still going at it. The last I heard, or what I read this morning, I should say, was that they're trying to change the definition of who should be entitled to the payout. Instead of everybody getting it, they're going to means test it, essentially. People with a salary down perhaps as low as $50,000 would be the top. So regardless, we'll have to see how far they go. It's definitely needed. Inflation data. We've got wage data coming out Wednesday, CPI data. We'll talk about that a little bit further when we get into the detailed discussion, the day-by-day stuff. UK GDP is coming out. And of course, whacked with Corona, whacked with Brexit. Not totally sure how this is all going to play out. We'll just have to give it a try and see what happens there. And finally, we got Mario Draghi, and he's got a lot on his plate, guys, in terms of what's going on in Italy. And we'll have to watch Draghi. The Italian tenure narrowed against the Bund, the German tenure Bund. The spreads really sharply narrowed on news that Draghi got appointed. So that was positive. It was interpreted positively by the markets. So we'll give him a chance and see what happens there. Overall, we'll take a look at the S&P 500 for the past year. Once again, guys, this is off the wonderful FinViz. And you know how to read it. Green is good, red is bad. And we can see this market over the past year, largely tech, Microsoft, Apple, Amazon. Look at these enormous gains. My gosh, Google, really substantial gains in the market. Losers, energy was doing pretty well. There seems to be a little bit of a recovery coming back up in that sector. Utilities, aerospace and defense, and banks were sort of a mixed picture over there in the lower left-hand corner, financial. Now, one key question, guys, and what I've got here is I've got the NASDAQ advancing, declining stock volume. Guys, look at this. So far in 2021, we've only seen 2 down days. It's really wild. And of course, on the right-hand side, what I've got here is I've got the square going back roughly until November. And then you can see when we take a look at 2021, we've only had 2 days when it's been down. So reasonable question is, where are the losses? Why are we just seeing stuff going up and up and up and up? Well, we have seen this before. And I do have to draw a parallel with the dot-com bubble. So the dot-com bubble, that chaotic correction that we had in March, April of 2000, in the run-up in the in 1999, late in the year there, we did see the same performance, or the same characteristic, I should say. A lot of up stocks, very, very few down days. And the markets just went up, up, up. And maybe it's going to repeat. We'll talk about that. I've got another chart to show you in a second. Regardless, we can take a look at the VIX. We can get an idea of how market participants are viewing future volatility. Of course, the VIX, sometimes called the fear index, the ratio of puts to calls, and we won't go into the composition. Here at the bottom, you can see the green line. VIX is tracking at 27.16, but we've got VIX futures. Like any proper derivative, there are derivatives at a baseline, it is the underline. And you can see market participants are actually betting up or anticipating a little bit more volatility in the March to April time period before things start to calm down, before it starts to track down. And this is all driven, of course, by the number of up days that we've seen in the markets and the idea that just stuff is going up, 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 up. But another thing, take a look at price to earnings ratios. I've got these globally. So from the left-hand side, we got MSCI Eastern Europe. On the right-hand side, we got the United States. And the US market is definitely trading at heightened price to earnings ratios. The average typically is about 17. We're tracking 22.4 right now. It's not a phenomenon that's characteristic, or pardon me, restrained to the U.S. only. You can see the MSCI All World Index, MSCI Emerging Markets Asia, definitely trading up at higher levels. Here's an interesting one, guys. We know that the Corona crash was an exogenous event. We know that the global financial crisis was triggered by an exogenous event. Check this out. If we take a look at the S&P 500, if we track from March 2009 forward to 2010, if we do the same thing for S&P 500 from the March 2020 lows and tracking forward again roughly 1 year. Look at that. Look at the degree of correlation. These lines tend to move together. And if this playbook, as it's called, manifests, if it does come to fruition, we're expecting to see a fairly sharp drop in the S&P 500. Some people are calling it between 10 to 15%. I don't really operate like that. I would welcome a drop because I do have a lot of liquidity and there's some stocks I want to buy, but I ain't going near them at these prices. But still, somebody may be expecting trouble at Tesla. I put it in question mark for a reason. This is all over the place, this chart. Comes from Bloomberg. And what we're doing is we're looking at the Tesla 600 puts. Somebody went out there and bought 922 contracts, a phenomenal number. And of course, when you buy an options, or 992, I'm so sorry. Of course, when you buy an options contract, it controls 100 shares. So essentially what they're doing is they're able to have economic benefit from a fall in price of 99,200 Tesla stock shares. And that's roughly a position worth about $6 million. Now, I put it in question mark. Some people aren't as cautious. They're a little bit more definitive and say, yeah, Tesla's going to crash. Somebody knows something. We never know what's on the other side of this trade. And it may be someone who's long Tesla at 600, and they just want some downside protection. We don't really know. So we can't assume it's purely a speculative position, as a lot of people tend to do. Oh, and you just know we're going to talk about this. I got to tell you, GameStop was the most entertaining thing I've seen in a long time, and I've been in the markets since the 80s. Here we go, guys. Watch the GameStop saga. Of course, GameStop, before people started messing with it, was trading for a long, long time at $5. And then they got an investor who put a bunch of capital in, joined the board, was going to turn the company around, refocus it, perhaps along the lines of an internet-only business. In other words, get rid of the bricks and mortar and focus just on online activities. Well, that drove the stock up to 20, and then the madness, as I call it, happened. So from 1, you can see, into January 25th, we had a nice run up, almost to 150. Then it dropped down to about 75, still off its prior highs. And then it ran up again, all the way up to north of 400, close to $500. Then it dropped precipitously, my God, all the way down to about 128, I believe it was, number 3. And then it pumped up, and then it started this drop. Now, the reason I'm bringing this up is because these guys who are all over these message boards, they keep saying, I'm not selling. I'm not so sure about that, honestly. If you had a position, why wouldn't you sell it when it just spiked up on January 25th if you bought it at 20 or below? As a lot of these guys claim they were acquiring shares at $5. Why in God's name wouldn't you sell it when it got to 150? That's an enormous return, whether you paid 5 or 20. It's an enormous return on your investment. Why wouldn't you sell after that drop there, January 25th? Why wouldn't you sell when it rocketed up north of 400, close to $500? Why wouldn't you sell? Why wouldn't you sell when it hit number 3? You could say the shine's off. Why wouldn't you dump it then? I'm not so sure that these guys didn't sell. And of course, now even at 65 over here, or 63 where it closed on Friday, there's a bunch of people claiming, I'm never selling, hold the line, and all this interesting stuff. I'm a little dubious of all that talk, guys, just to be totally honest with you. All right, let's get into the daily stuff. Now, I'm trying to restrict this to 1, maybe 2 things to bring this whole video in under 10 minutes. That was some feedback I got from some students. So Monday, February 8th, look at that perfect animation. Isn't that great? All right, at 1000 hours, we got the CB, the Conference Board Employment Trends Index. Now, for January, prior was 99.1. We don't have a forecast now. This is one of these indicators that I really like, guys, because what we're doing is we're bringing in 8 labor market related indicators, bringing them into a single index that we can watch at. We're looking at things like, what percentage of respondents to a survey said it was hard to get a job? What were initial claims for unemployment? Percentage of firms with positions they can't fill? Number of employees hired by temporary help? Part-time workers for economic reasons? Job openings, industrial production and manufacturing, and trade sales. And once again, higher than expected reading is positive, and lower than expected reading is negative. It's something to be careful about. 11:30 hours, we got 3-month and 6-month T-bill auctions. Once again, we see this sharp drop in yields. So 6.5 basis points on the 3-month prior and 7 basis points on the 6-month prior. Tuesday, February 9th at 10:00 hours, we got JOLTS, Job Opening and Labor Turnover Survey. We're looking just at the job openings component at this point. And this is an interesting one because what we're doing is we're seeing the number of jobs that were opened, trying to get a feeling for how well the economy is actually performing or not. On Wednesday, February 10th, we got at 08:30 hours, we got core CPI, Consumer Price Index, year on year for January. Prior was 1.6, we're forecast to come in at 1.5. Deflation, maybe. Take a look at what's going on at 08:30 hours. Core CPI again, month on month for January. Prior at 1/10 of 1%, forecast at 2/10 of 1%. It's nothing substantial, guys. We're not seeing it. It's really fascinating that we see overall this artificially low or really, really low inflation. It's nothing that is appropriate. And we should be seeing some type of pricing pressure, but we're just not now. All right, Thursday, February 11th at 08:30 hours, we've got initial jobless claims. Prior 779K, forecast to come in at 750. And at 1100 hours, a Fed monetary policy report. I love this. This is an interesting one. It's a semi-annual report that the Federal Reserve has to write and submit both to Congress and Senate, to various bodies, panels, committees that sit there. And what they do is they talk about what they were doing with monetary policy over the horizon, and they try to assess the impact. So they look at the economic developments and they look at the prospects for the future. It's a very good one, guys, to look at to get an idea about what the Fed thinks of its own performance. And it's very good. Try to take a look at it. It's something that I do look at briefly. And it only comes out twice a year, so it's no big deal. Friday, February 12th, we at 10:00 hours, we got two things. Michigan 5-year inflation index. Expectations, I should say. And for February. And guys, prior was 2.7. Forecast, don't have a forecast. Now, what this is saying is that when they survey, participants or respondents to the survey are saying they expect over the next 5 years for inflation to trend up to about 2.7%. That is roughly in line with what we'd expect to see. We'd like to see a healthy, perhaps 2 to 3% inflation. That just means wages are rising, prices are rising, the economy is tending to perform well. We'll see if this actually comes to fruition. And at 10:00 hours, we got the Michigan Consumer Sentiment. And once again, guys, what they do is they go out and survey, I believe it's about 500 consumers, and they try to understand what their feelings are towards the economy as a whole. Prior 79, forecast to come in at 80.7. Now, keep in mind, guys, this is important. We watch this because some 70% of U.S. GDP comes from consumer spending. And if the consumer feels good about the economy, then yeah, they're spending money. They're going to splash out. If they're not feeling too good about the economy, even if they have the money, they're not going to spend it. So it is an important one to get a look at. All right, guys, that's it for the week ahead. Once again, my name's Dave Coker. Have a profitable week. Oh, how about that crazy Bitcoin? My gosh, currently tracking roughly 40,000. Fantastic. New trading range. I hope it will never drop below 40 or substantially below 40 again. Not totally sure. But whatever market you're in, guys, try to make some money this week. Think about the markets. Think about what you anticipate will happen and structure your portfolios accordingly. Thanks for your time, guys. Take care.